Have you ever stood in a store with a full wallet of cash and still felt powerless? Maybe you were buying a pack of meat or a set of tools, and the cashier pointed you toward a taped-over slot or a glowing card reader that didn't care what you were holding. It's a small embarrassment, but it hits deeper than we admit, because it shouldn't be this hard to spend money you already earned, and yet that moment is becoming strangely common. You walk to an ATM that used to sit by the door and it's gone. You ask for a bigger withdrawal and the teller tells you to come back tomorrow. You reach for cash because it feels safe and the world around you says, not anymore. None of this is random. None of it is temporary. It's a slow, steady squeeze that has changed how America moves money without ever asking how you feel about it. So tonight, let's walk into that discomfort together and face why getting cash in 2026 is becoming harder and why the cost of losing it might be far greater than you think. ATMs are drying up faster. ATMs are disappearing faster than banks can justify replacing them, and the numbers alone should make you brace yourself. Across the country, ATM totals have been sliding for years, and every missing machine means one more place where cash quietly becomes harder to reach. You feel it most when you need money fast, not when you're browsing a balance, but when you're standing in front of an empty corner where a machine used to be, realizing your only option now is to drive farther, pay more, or give up. The truth is simple: when ATM networks shrink, the cost of getting your own money rises. Fees have climbed to painful levels. Out-of-network charges now sit at nearly $5 per withdrawal, and that's before your bank adds its own penalty. In practice, this means the people who rely on cash, the most older Americans, rural families, small-town workers, lose a little more of their income every time they pull out a 20. It is a slow drain, but a steady one, the kind that eats at monthly budgets without announcing itself. Meanwhile, the backbone that once kept cash-flowing local branches is thinning too. Branch closures are accelerating, especially in areas that already had limited financial options. When a town loses its last branch, it does not just lose a building. It loses the staff who handled exceptions, the vault that supported ATM, refills the oversight that ensured machines stayed working, and the simple ability to solve a problem in person. In many places, an ATM vanishes the moment the nearby branch shuts its doors and nothing comes to replace it. Cash access fades not in an instant, but in the form of doors that never reopen. At the same time, ATMs that do remain are more fragile than most people realize. Independent operators, the small companies that run standalone machines in gas stations, pharmacies, and corner stores, face higher costs for maintenance, armored transport compliance, and insurance. As those expenses rise, their margins shrink. Many choose to remove machines completely rather than fight a losing financial battle. And when they pull out, the gap they leave behind is rarely filled by banks, because banks are moving toward digital strategies that no longer prioritize physical cash distribution. What makes this shift even rougher is that consumers don't feel the erosion all at once. They feel it in small irritations: an extra fee here, an out-of-service notice there, a longer drive to the next town. But underneath those annoyances sits a much harsher reality. Every missing ATM reduces your ability to control how and when you use your own money. Cash gives you privacy protection during outages and a spending limit you set with your own hands. Losing access to it slowly transfers that control to institutions that prefer digital transactions, because digital transactions generate fees, data, and patterns they can monetize. And this is where the financial pressure becomes personal. When withdrawing $40 costs nearly $5, the math punishes anyone living paycheck to paycheck. When the nearest ATM requires a long trip, the cost shifts from dollars to hours. When machines disappear completely, people are pushed into card-only systems that may charge overdraft fees, hold deposits, or decline purchases during outages. None of those risks exist with cash, but access to cash is becoming a privilege instead of a standard service. So when you see an empty spot where an ATM used to stand, understand what you're really looking at: not just a hole in the wall, but a sign that the country is making it harder for ordinary people to hold and use their own money, and the ones who can least afford that loss are the ones paying for it first. Banks are quietly limiting how much cash you can actually take. Banks will never say it outright, but they make it harder to pull out cash than most people expect. You notice it the first time a teller tells you to come back tomorrow for a larger withdrawal, or when the ATM quietly refuses anything above a certain limit. It feels strange because the money is yours. Yet the moment you try to take out more than a modest amount, the process slows down, questions appear, and the window of what is allowed suddenly narrows. The practical impact hits fast. Daily caps restrict how much you can access in one trip. Larger withdrawals trigger extra checks, identification steps, and delays. Teller lines shrink as branches reduce staff. And in emergencies, a medical bill, a family need a sudden repair, you discover that available balance does not mean available right now. Cash still exists in your account, but the steps required to reach it keep expanding. For families living close to the edge, that delay is not a small inconvenience. It can mean missing a bill deadline, losing a purchase price, or being unable to help a relative in time. For older Americans, it becomes another layer of dependence on systems that already feel distant. For small-town customers, fewer tellers mean longer waits and fewer exceptions approved. Every added barrier makes physical cash just a little less accessible each year. Why this happens comes down to a simple financial reality: managing large volumes of physical cash costs. Banks' real money. Cash must be moved, counted, guarded, reported, and insured. It requires armored trucks, vault space, and staff training. Each time a customer withdraws a significant amount, the branch needs enough liquidity on hand to stay compliant. That means they hold more idle cash, which earns no interest. And in a system where banks are judged by efficiency ratios, unnecessary cash, sitting in a vault is a drag on performance. Banks also face strict reporting rules. Any single-day cash movement above $10,000 requires formal documentation. Even amounts beneath that threshold can trigger internal reviews. These measures were created to fight fraud and criminal finance, but they shape behavior far beyond that world. Many institutions now set internal thresholds that flag withdrawals long before they reach reporting levels. Not to block customers, but to protect the bank from regulatory risk. One former risk officer described it plainly: cash is the most expensive asset to hold and the hardest to justify at scale. Every dollar sitting in a drawer is a dollar not working for the bank. Once you understand that, the friction makes more sense. Smaller daily limits keep branch liquidity stable. Fewer teller windows reduce labor costs. Encouraging customers to call ahead lets the bank prepare without holding too much idle currency. All of it pushes the system toward digital rails, where transactions are instant, traceable, and profitable, and away from the slow physical handling of bills. But here's the part that should give you pause: cash is the only form of money that does not depend on a network, an approval, a timestamp, or a processor. When access to it becomes restricted, even slightly ordinary people lose the one tool that works during outages, errors, and unexpected crises. And this tightening is only the first step, because even if you manage to withdraw cash, you still face another obstacle: more and more stores no longer want to take it. Retailers are moving away from cash by design. Retailers are stepping away from cash faster than most people realize, and the numbers prove it long before the signs on the checkout counters do. Across the country, self-checkout now appears in almost every major grocery chain, and surveys show it handles nearly 1/3 of all transactions. Cashier positions continue to decline year after year, replaced by kiosks built for cards and phones. Some stores have even tested card-only lanes before states stepped in and forced them to accept cash again. When you look at the trend line, the message is unmistakable. The physical act of handing over bills is being engineered out of the modern shopping trip. You see the effect each time a lane closes or a cash slot stays covered. A store gains speed, but the shopper loses flexibility. When labor budgets shrink, fewer staffed lanes stay open, and the remaining ones push long lines into a smaller space. People in a hurry default to the machines, and the machines default to digital. For anyone who depends on cash, older shoppers, workers paid in tips, families budgeting envelope by envelope, their payment method becomes a problem rather than a choice. There is another layer hidden beneath the surface. Handling bills costs a store time and money. Cash must be counted, verified, secured, and transported. Every step involves risk. Theft, human error, and end-of-day reconciliation mean more labor hours. Digital payments avoid all of that, so stores quietly tilt their layout toward the method that costs less to manage. Shoppers feel that tilt when they have to search for the single lane still accepting cash, or face a kiosk that asks for a card before offering any other option. The pressure lands hardest on people who cannot shift so easily. A teenager buying school supplies with money earned from a weekend job cannot explain to a machine why cash is all he has. A pensioner with limited mobility cannot stand in a growing line simply because her store reduced staffed lanes again. And when stores normalize digital-first checkout, the message spreads well beyond retail. Cash may still be legal tender, but it is no longer treated as the default. Now, picture something simple. A housewife stops at the store after work. Dinner needs to happen fast, and she has the exact amount set aside in an envelope. She chooses the ingredients, reaches the checkout, and finds every kiosk card only. The one staffed lane stretches halfway down the aisle. She looks at the bills in her hand, money she planned carefully, and suddenly she cannot use any of it. What is she supposed to feel in that moment? Embarrassed, pressured, left out of a system she never opted into? These moments matter because they add up. When a method of payment becomes inconvenient, people stop using it. When people use it less, stores have even less reason to support it. And slowly, a form of money that once worked for everyone becomes workable only for those who fit the digital mold. The reality is not that cash is disappearing tomorrow. It is that every change in store layout staffing and checkout design nudges it a little further from everyday life. If you rely on cash even occasionally, the smartest move is simple: plan ahead. Keep a store or two in mind that still accepts it without barriers, and stay alert to how quickly that freedom is narrowing. Policies and incentives shaping how cash circulates. Policies and incentives might sound distant, but they touch your wallet more quietly than anything we've talked about so far. ATMs disappearing and stores turning cash away feel obvious. This part doesn't. It slips in through rules paperwork and cost decisions almost nobody ever sees, yet they influence how easily a single dollar moves through your hands. Banks operate under layers of requirements whenever they handle physical money. Every stack of bills creates work counting, verifying, storing, transporting, insuring, and documenting. When a withdrawal crosses certain thresholds, they must file reports. When it doesn't cross those thresholds but looks unusual, they must investigate. These steps exist for good reasons, but they come with real financial weight. Staff must be trained. Compliance teams must review submissions. Armored trucks must be contracted. Vaults must hold enough reserve. All of this is expensive and none of it produces revenue. Digital payments sit on the opposite end of that equation. They move quickly, cost less to process, and generate automatic records. A branch that keeps heavy stacks of cash on hand earns nothing on that idle money. A branch that handles mostly digital flows looks cleaner on its balance sheet. When you see it from the bank's side, the incentives line up neatly, reduce the physical work, increase the digital flow, and lighten the compliance load. Currency circulation adds its own pressure. Bills wear out. New ones must be printed, shipped, counted, and distributed. That requires a national logistics chain that grows more expensive every year. As fewer purchases are made with cash institutions, shift resources away from these physical movements. The money still exists in huge volume, but the machinery that moves it is slower, thinner, and more costly to maintain. Digital transactions demand none of that effort. Over time, the system leans toward what is cheaper to support. Nothing here is secret. Nothing here is illegal. It is simply a financial structure responding to cost efficiency and operational reality. But the way it reaches the everyday customer can feel harsh. Cash access becomes slower. Certain withdrawals take longer. Verification steps multiply. Someone who budgets with envelopes suddenly needs to justify a normal transaction. Someone who saves in bills finds fewer places ready to handle them. A method that once worked smoothly for everyone starts working smoothly only for those who follow the digital path. Picture a woman who manages her week by setting aside exact amounts in cash. She goes to her bank expecting a simple withdrawal, only to be told it requires extra time or questions. She didn't change anything about her habits. The environment around her did. Picture a worker whose schedule doesn't match limited branch hours. He arrives to deposit or withdraw and discovers a long line or a locked door because the location cut its staff again. The rules shaping cash movement were never written for him, yet he absorbs the inconvenience. These frustrations aren't random. They're the downstream effect of a system that finds digital payments easier to support than physical ones. And the next force pushing you in that direction doesn't come from policy at all. It comes from the companies that earn money every single time you tap, swipe, or scan. How payment companies profit when cash fades. Now let's shift the angle a little. Have you ever wondered who actually benefits every time your money moves through a card, an app, or a digital wallet? Because someone does, and it's not you, not the store, and not your bank. It's the payment companies sitting in the middle of every transaction, collecting a small slice each time you tap, swipe, or scan. In daily life, that slice feels invisible. You buy groceries, tap your card, and walk out. But behind that simple motion is a chain of fees. Visa and MasterCard charge a percentage every single time a card is used. Digital wallets route payments through those same networks, adding their own layers and incentives. The more people rely on digital payments, the more these companies earn, not through savings accounts or loans, but through a constant stream of tiny cuts taken from merchants. Those tiny cuts grow into billions. Payment networks thrive when cash use declines because digital transactions are the only place their revenue lives. A store that accepts 100% cash generates zero income for these companies. A store that pushes customers to cards, mobile taps, or QR-style checkout turns every purchase into a source of profit for someone sitting far away from the counter. When you see checkout lines pushing customers towards self-checkout or apps offering tap-to-pay perks, those incentives are not random. They're built to normalize the payment style that strengthens the network's earnings. This shift changes daily life in quieter ways. When merchants pay these fees, they adjust prices to cover them. A cup of coffee, a pack of batteries, a loaf of bread, they all carry the cost of someone else's transaction fee. You never see it on the receipt as a separate line, but it's built right into the final price. Over time, consumers pay more for the convenience they think they're getting for free. Meanwhile, payment companies position themselves as innovators while expanding the very system that makes every purchase a revenue event. Small businesses feel the pressure even more intensely. Many operate on thin margins, and a nearly 3% processing fee can swallow most of their earnings on certain items. This is why some shops push minimum purchase rules, offer discounts for cash, or quietly hope customers choose bills instead of cards. But when the world shifts toward digital by habit, small merchants lose leverage. They must participate in the system, even if it weakens their bottom line. From the consumer side, the story isn't just financial, it's behavioral. Once people grow used to tapping for everything, they become less aware of their spending. They rely on networks they cannot see, controlled by companies they never interact with, governed by policies they never voted for. Cash anchors spending because it is tangible. Digital payments smooth over the friction, and payment giants profit from that smoothness. The irony is that the companies shaping this shift never have to say a word about cash. They don't need to ban it. They simply make digital payments easier, faster, and more rewarding, until paying with actual money feels like swimming against the current. And when the current is strong enough, people stop noticing they're being pushed, they just follow the flow. But this flow has consequences, especially for the people who rely on cash the most. And that's where the story turns from business incentives to real human vulnerability, because the ones who still need cash are often the least able to afford losing it. The people hurt most when cash becomes hard to use. Some Americans cannot switch to digital money even if the world around them already has. For them, cash is not nostalgia. It is structure. It is control. It is the only way the numbers in their life stay steady. When cash becomes harder to use, their footing slips, and the people who feel it first are often the ones with the least room to fall. I want to tell you the story of Robert, one of the men I talked to a few days ago. He's 56 years old, works at a small auto shop in a town where the nearest bank is almost 20 minutes away. He is not poor, but every dollar in his month has a job. His wife, Linda, works part-time at the school cafeteria. Their youngest son still lives at home while trying to start a career. Nothing is extravagant. Nothing is wasted. Cash is how Robert keeps things straight. He divides it into envelopes on Sunday night groceries, gas prescriptions, church, rainy day money. It is a simple system, and it has kept their family balanced through times both good and thin. But the world around him is changing faster than the routine he relies on. The ATM near his shop was removed last year. The gas station replaced its old cash drawer with a machine that often jams. The grocery store installed rows of self-checkout kiosks that refuse bills. Even his pharmacy, the one he has visited for 2 decades now, asks customers to use card if possible to speed up the line. No one is forcing him to change, but the ground under his feet is moving. Robert feels it in small moments that build over time. On a Thursday afternoon, he drives to the bank to withdraw his usual weekly cash, only to find a line long enough to wrap around the lobby. 2 tellers instead of 4. He waits, watching the clock, knowing the shop needs him back soon. When he finally reaches the counter and asks for a little more cash than usual, a family birthday is coming up. The teller hesitates and asks him to show extra identification. She explains it gently, but he still feels a sting he cannot name. It is his money. He planned for it. Yet the process has become something he must prove himself worthy of. Later that evening, he stops by the grocery store. He has cash in his pocket because that is how he tracks his spending. But the only open lane is a long, tired line of shoppers, each carrying more impatience than groceries. The self-checkout lights flash like invitations, but they do not take cash. He stands there holding bills that once worked everywhere, wondering when they became an inconvenience instead of a payment. At home, he spreads the envelopes across the kitchen table, but they no longer give him the sense of control they once did. Prices have climbed. Digital systems are shaping behavior he never asked for. He watches his son pay with a phone tap done no thought. He wonders if he is falling behind or if the world is simply stepping over people like him. Robert does not fear technology. He fears losing the one system that kept his life steady. Cash made the month predictable. Now the rules around it keep changing, and every small shift chips away at the confidence he spent years building. Stories like his are not rare. They are becoming the quiet, uncomfortable truth beneath the push toward digital convenience. And as cash becomes harder to use, the gap widens, especially for people who still depend on it just to stay balanced. When the system fails, cash becomes the only backup. After all, you may feel digital money is entering its era, but in fact, the oldest form of payment still holds one quiet advantage nothing else can replace: when everything breaks, cash keeps working. That truth showed itself clearly during the massive CrowdStrike outage earlier this year. Airports froze, hospitals stalled, payment terminals blinked out across entire regions. People stood at checkout lines holding perfectly good debit cards that suddenly meant nothing. No one made a mistake, No one overspent. The system itself simply stopped breathing, and every dollar trapped inside that system became unreachable. Events like that expose something Americans rarely think about. Digital payments depend on electricity servers, networks, cloud platforms, and private companies running without interruption. A single broken update, a disrupted data center, or a severed fiber line can shut the door on millions of people at the same time. A card has no value without a signal. A phone app is useless without a server. A bank balance may as well not exist if the terminal cannot verify it. Even small failures can spread far. A storm knocks out power in a county. A cyber attack slows verification servers. A payment network experiences a routing glitch. Suddenly, gas pumps stop accepting cards. Grocery stores move to cash-only signs. Pharmacies pause transactions. Life becomes a maze of locked doors. And each time it happens, people are reminded that convenience is not the same as stability. Imagine the scale if something larger hit a solar storm disrupting satellites or a targeted attack on a major network operator. These possibilities are rare, but they are not imaginary. They have appeared in government assessments and utility reports for years. Modern life rests on a web of fragile connections, and digital money is tied to every strand. The stronger the digital push becomes, the more painful it is when one link snaps. Households feel the impact instantly. Parents trying to buy groceries find every terminal offline. A man stopping for gas before work cannot fill his tank because the pump cannot verify his card. A woman picking up medication watches the system freeze while the line grows behind her. None of them did anything wrong. The tools they rely on simply vanished for a few hours, and with them went their ability to function. Cash avoids all of that. It does not crash. It does not require a reboot. It does not depend on a network in another state or a server in another country. When the lights go out, a $20 bill still buys diapers, fuel bread, or medicine. When a system outage freezes, the card reader's cash keeps families moving. When every digital door locks at once, cash becomes the only key left. That does not make digital payments the enemy. It makes them incomplete. They work beautifully until the moment they don't, and by then it is too late to prepare. The wisest thing any household can do is simply keep a small cash reserve for moments when the system falters, not out of fear but out of respect for how modern life truly works. Because as America leans further into a cashless future, the one question that matters most is the one people rarely ask. What will you use if the entire system stops at the wrong time? How to protect yourself in a country that's using less cash. You cannot control how fast the country moves toward digital payments, but you can make sure your own household is not exposed when the weak points show themselves. The goal is not fear, it is stability. And stability starts with a few simple habits that keep you protected no matter what direction the system takes next. The first step is keeping a modest cash reserve at home. Not a large emergency stash, not anything unsafe, just enough to cover a few days of groceries, fuel medication, or basic supplies if digital payments freeze for a short period. Most families know their own rhythm, what they spend in 2 or 3 days, what items they buy, most often how quickly they move through essentials. Matching your cash buffer to that rhythm is both legal and responsible. It keeps you functional during outages without disrupting your normal banking routine. Next is understanding your bank's withdrawal policies before you need them. Many people learn about delays or limits only at the counter, usually at the worst moment. A quick check with your branch daily caps ID requirements. Call-ahead procedures for larger withdrawals prevent surprises later. This is not about challenging the rules. It is simply about knowing how they work so you can plan around them. When the system becomes less predictable, information becomes one of your strongest tools. A third safeguard is diversifying your payment methods. Even if you prefer digital transactions most of the time, it helps to keep more than one option active: a debit card, a credit card, a mobile wallet, and a small amount of cash. Each method has strengths and weaknesses. When one fails, another fills the gap. In a modern economy, flexibility is a form of protection. It also helps to know which nearby stores still accept cash without barriers. Every town has a handful of businesses that maintain full cash support alongside digital payments, local groceries, smaller pharmacies, family-run convenience stores. Keeping mental note of those options means you will never be caught off guard during an outage, a network failure, or even a routine maintenance event that freezes card terminals for a few hours. Cash-friendly stores are not old-fashioned. They are resilient. Households can also reduce stress by building tiny routines around preparation. Refilling prescriptions before the last day. Keeping the fuel tank above the bottom quarter. Buying small necessities a little earlier than usual. These habits cost nothing and prevent the exact kinds of emergencies that become harder to navigate when digital systems fail. Stability is rarely about big actions. It is built from small, steady choices. Most important preparation should never slide into panic. Keeping a small cash buffer is legal and sensible. Withdrawing excessive amounts is neither helpful nor necessary. The banking system still operates, digital payments still function the vast majority of the time, and cash remains valid everywhere by law. Your aim is not to outrun the system, but to stay comfortable when it stumbles. A country that uses less cash is not automatically unstable, but it does require families to think a little differently. You protect your home the same way you protect anything else, by understanding how it works, seeing where the stress points lie, and giving yourself a backup you can rely on. And once you build those habits, the shift toward a digital economy feels less like a wave you must brace against and more like a landscape you can move through with confidence. The truth is, cash isn't disappearing tomorrow, and digital payments aren't the villain. What's really happening is a shift fast, uneven, and easy to miss until it reaches your own routine. You've seen how ATMs thin out, how stores lean toward cards, how banks tighten their rules, and how outages can turn a simple purchase into a roadblock. These changes are small on their own, but together they shape how much control you actually have over your own money. And control is the heart of this whole conversation. Not fear, not nostalgia, just the simple idea that your ability to live by help and handle emergencies should never depend on whether a network feels like cooperating today. So, as the country moves further into a digital future, keep one thing in mind: the strongest position you can take is awareness and the calm, steady habits that come with it.
This video does not promote division within the United States or encourage segregation. All content is presented for the purpose of exploration, analysis, and fostering discussion based on current events, public sentiment, and social trends. We fully respect the United States Constitution and all federal regulations. If today's analysis made you think, drop a comment so we can keep the conversations going. And don't forget to like, subscribe, and hit the bell so you will never miss our next independent deep dive.